Thank you, and good morning, everyone. It's that time of the year. I think it's been, I don't know how many years of my association with IVCA, so I think it's always a pleasure and good fun to kind of see all of you here and meet, catch up with people that you otherwise don't get to catch up otherwise. So I think when I was given, and since we are coming straight out of the World Cup fever, when I was told that we are on the panel and we are the first panel, it almost felt like Surya losing a toss and being put into bat. So I was like, okay, we don't get much breather. And then with all the eminent panels over here, I think getting everyone coordinated to do a pre-panel call was obviously a challenge, but we still managed. But I think when I saw the panel, then just like Surya, you feel like you have a Sanju Samson, you have all the great openers, you have Ishan Kishan, and then of course to top it up, we have Smriti Mandhana and Shafali Verma as well. Then I think I was pretty relaxed that my job is much easier. So I think that's where we are here. So I think just to set the backdrop, I think what we really looking at, I think India, if you really go back, 10 years back from an LP perspective, was really taking a bet on India. And I think it is more about making an allocation, not fully being certain about what really India will generate for the fund and as an outcome or as a governance. A lot of it was really up as a question. Fast forward to today, I think obviously India's come way ahead. I think it's very much part of a planned global allocation, and obviously with how things have evolved for India, not just the way it has performed as an asset class, but also as what's happened globally in relative terms. India is very much part of the global allocation and with an increasing share. So that's really something that brings us to the panel here, because over the next 2 days, we're going to look at India a lot more from inside, like a GP perspective or an advisor perspective or a regulatory perspective. But I think this is the panel where we're going to kind of see India from outside, from the global allocators perspective, how they look at India as asset class. So I think to really make it interesting, and I think we're broadly going to cover it in the theme of macro story about how India has evolved as an asset class. We move down into something more on the governance and other aspects of the funds, GPs, and what is the expectation of LPs. And finally, moving down to assessing how the risks, currency risk, political risk, regulatory risk, and where India kind of matches up. And I think we couldn't have asked for a better panel than what we have over here. So I think I'll also do a very quick introduction to the panelists here so that when you hear them, you also realize what perspective they bring to here. So I think to start with, we have, of course, Amit Chandra from 57 Stars. It's a globally focused fund of fund manager with over USD 4.5 billion of commitments, investing thematically across asset classes, high growth sectors in emerging markets. And he's been an active investor, including through direct co-investment. Following him, we also have Neha. I think she needs a little introduction. I think she's leads the private equity funds group for IFC in India with over 2 decades of experience. Under her leadership, I think IFC has really been able to implement a very robust framework for deployment to Indian funds, and I think we've seen the growth in how IFC has been allocating capital into India. So she will obviously share her DFI perspective. Then we have Rohit Agarwal. Again, Rohit is he's an advisor, alternatives investment advisors based out of Hong Kong. I think he represents Axia, which is the institution which is advising over 300 billion in institutional allocations. And Rohit leads their Asia private equity research and due diligence. So obviously his perspective on GP selection would be very, very useful. Following that, we have Ralph. Ralph is part of responsibility. Again, a Swiss-based impact asset managers with over USD 5 billion in AUM. I think in his, and his role as also he plays the role of a CIO for SIFEM, which is the Switzerland Development Finance Institution. And beyond that, he also kind of allocates capital to other funds beyond SIFEM. So he obviously has a great experience, DFI experience, and impact investing as well. And lastly, I think we have Shilpa Kumar again from BII. I think Shilpa heading the India operations for BII, a long-standing investor into India, globally about 9.9 billion pounds of capital, net assets, and I think India features amongst the top allocation for BII. So sorry to take it a little longer as introduction, but I thought it is something which is going to be important so that when you hear each of them, you really get a very diverse and a wide perspective on India. So I think maybe with that, let's kick off the discussion. I think in the first instance, I think let's start with the macro, and then maybe I think, Rohit, we can probably start with you in terms of India's India's moved from an overweight economic emerging market to really a core allocation for a lot of global funds, including those that you advise. So in your assessment, what has really changed, and what has really been driving that as from an LP perspective?
Sure, I can kick it off. I think if I've been investing in India for a long time now, and sort of looked at it from various lenses, starting off as a direct investor to doing co-investments to now looking predominantly at fund investments. And really you see the Indian private equity landscape and the industry mature over the last 10, 15 years. And it coincides with the broader financial industry maturing in India as well, right? So if you think about the financialization of savings, the movement of money into mutual funds, into the public markets, that itself has happened over the last 10, 15 years, and the Indian private equity industry has matured alongside it. And as that industry matured, I think it has attracted the attention of a lot more GPs who started to spend a lot more time here, and then correspondingly that has attracted a lot more LPs to also come to the market, right? What do I mean by that? I remember my time, 10 years ago when we were looking at India, investing in India from a Pan-Asian manager perspective. India used to be one of the markets that people would look at. Bulk of the allocation would still go to China. People would still look at some of the other markets. And India would be one of the others, in that pack. Today, without naming names, and if you just pick any Pan-Asian manager, and just as examples, you pick Blackstone, you pick Bain, you pick EQT, any of those Pan-Asian managers, and if you talk about them, where is it that they want to allocate capital in Asia, India would be one of the top 2 markets that would come up, maybe alongside Japan, as one of the markets they want to really focus on, really invest behind. So what has changed in all of that time frame? I think there are 2 or 3 things that have changed, and all of that has helped mature the industry, right? Firstly, from a deal flow perspective, there are a lot more Indian entrepreneurs who become savvy of running their businesses in a clean fashion and really looking to generate deal flow for private equity. What I mean by that is 10, 15 years ago, people still thought about how do I, quote unquote, run my business in a way such that I benefit from it. The cash that I get at the end of the year, end of the month is what I'm trying to maximize. Over time, what people have figured is that, when I take this company to the public market and if I run it cleanly, it's not just earnings, I get a 20 times multiple on it, I get a 25 times multiples on it. And that basically means that not only are they running their business a lot more efficiently and cleanly, but what they're also doing is looking to maximize that multiple. And as they look to maximize that multiple, that creates a lot of opportunity for private equity to come in and help those businesses professionalize, help those businesses separate from the families, help those businesses really get ready to list into the Indian public markets, and that creates a lot of deal flow opportunity. On the flip side, as this happens and as the public markets deepen, exits have become a lot easier for the Indian markets. 10 years ago, people used to still struggle that yes, money goes into India, but as an LP, when do I see it coming back? Today, exits are not really that big of a challenge. It's more about, is this the right time to exit? India as an economy is still growing at, call it high single digits, real rate of, at the real rate. Add on top of that, call it the nominal growth, which is much higher. Add on top of the fact that the economy is still moving from informal to formal, and you get a much higher growth rate. What that means is for a lot of assets that the GPs hold, there is still a long runway of growth left. And so, yes, some of the GPs might not be exiting their core assets, but it's not because they can't exit it. It's because they see this large runway for growth. Putting it all together, basically, the Indian private equity industry has matured, the market has matured, and as that market has matured, it has attracted more global participants, both GPs and LPs.
Sure. I think just moving to you, Amit, in terms of from a fund of fund perspective, and I think beyond what I just asked, one of the questions always been out there, how India compares to other Southeast Asia markets, and is it really the India conviction on India as a asset class, or is it really more of a China substitution? How do you see that from a global LP perspective?
Yeah, it's a good question. I think it's a little bit of both, right? So on the one hand, I think there is a growing recognition that the GP ecosystem in India has really matured, right? I mean, if I think about when I first started investing in Indian funds in 2008, you had lots of funds, almost all of whom were first-time managers. It was all Me Too investments, minority growth equity, with no strategy other than a hope and a prayer that the company can go public at inflated valuations. And then when that didn't happen following the GFC, all those funds crashed and burned, right? And if I look at the GP ecosystem today, there has been a winnowing out. The survivors, they've really matured. They have true sectoral expertise. They understand how to structure investments. Just a much greater focus on exits, as Rohit mentioned. So I think the fact that the GP ecosystem has matured, Rohit mentioned the capital markets environment in India has matured, which means that, for PE to thrive, you need capital formation, you need fund formation, you need a healthy investment environment, you need a healthy exit environment. And oftentimes, if I look at the bigger PE markets, the exit environment works because you have GPs, funds, at every size of the fund ladder, right? So you have a healthy ecosystem. And I'm beginning to see that happening in India now, where you've got, not large necessarily, but a decent size of credible, mature GPs at every step. And that's important, right? So that evolution needs to continue. And I think that's the positive for why, to your question on India on its own strengths emerging. I think the other part, there certainly has been some China substitution, but I think the reality is India is still very much at the beginning of really becoming a mainstay of global allocation, right? If I look at where the capital that left China went to, most of that, if I take the hat of US investors, most of that capital essentially just went back to the US, right? Yes, some of it came to India, but there's a lot more that can come to India, I think, in the future. So it's an evolution, and we're still very much at the early stages, I feel.
Maybe I think that's good to know that it's not just the China substitution. Maybe it's still early days of that evolution for India. But maybe I think, Neha, can I bring you in on your perspective again from a DFI? And we've seen how IFC's kind of evolved in its strategy from selective kind of deployment to a more structured approach, and then how you think that has really reflected.
Sorry, we're laughing because Ralph used to be with IFC for the longest time, and he used to head Asia before me, so he knows how our strategy has evolved. So I think from IFC's perspective, if I look at emerging markets, because IFC only invests in emerging markets, India is one of the most consistent countries which has shown growth and now exits as well, right? I think the issue, I became an LP about 7, 8 years ago. Before that, I used to be a GP. I think the only complaint we used to hear as a GP was consistency of exits. It was like, and I've said this before, it was like Chakravyuh, Abhimanyu's Chakravyuh, where Abhimanyu knew how to enter into the Chakravyuh, which is like GPs knew how to invest, but exits was always a problem. So Abhimanyu didn't know how to exit the Chakravyuh. Arjun did, but, and therefore we saw that where GPs were investing a lot in the country, but were not able to exit. I think that, thanks to one, the IPO sort of market, second, the robustness and the depth of the market, we are seeing that has now moved away. We have seen exits through IPOs, we've seen exits through strategics, we've seen exits through financial sponsors sort of buying secondaries, and I think the market is deep enough. So from IFC's perspective, I think if I compare it to other emerging markets, we are seeing the depth of the market, the quality of managers. There are many more managers who have got a track record of over a decade, over at least 1 to 2 fund cycles, having demonstrated investments and exits. And I think that is a big winner. I mean, for us as IFC, India is our single largest country exposure today in IFC. And that speaks volumes, right? And it's growing. We are one of the, I think, very large allocators in the country, both from a debt as well as an equity perspective. So definitely, I think Southeast Asia is also big, but the problem is Southeast Asia together is a big market. But if you look at the countries, they are not as large as or as deep as the Indian ecosystem. In India, in every segment and every strategy, whether it's VC, whether it's lower mid-market growth, private equity, larger sort of the mid-market, the larger segment, there are a lot of fund managers. As an LP, it's great for me, right? Because there's a lot to choose from. And honestly, sometimes it's very difficult because every strategy and a lot of fund managers we meet, it's difficult to choose because everybody has their own strengths. And therefore, for us, when we are allocating to 3 or 4 funds or 5 funds in a year, it's actually difficult to pick and choose. But then, of course, there are nuances and you have to sort of make a choice at the end of the day.
Great. No, thanks. Maybe I think, Shilpa, you want to share BII perspective and then we'll probably move to Rolf as well.
Yeah, so BII has a long history of investing in the funds industry in India. Like right from 1987, when we started, we primarily invested through funds. In fact, it's great to see that some of our first check funds at that time are today some of the biggest players in the industry today. I think where we've moved to now, just given the size of the industry and the amount of funds available, is we get asked the question, why do you need to invest in India, especially in the funds industry? And I think our answer is twofold. One is because as we look deeper into areas of strategic interest, which is today climate, especially gender and inclusion, we continue to look for partners who can push that objective of ours. That's the first. The second is really to drive maybe innovation and technology, and India has been great in terms of actually helping us find entrepreneurs who play in that space. So these are the two reasons we continue to invest in India. We do it through 3-4 ways. I mean, first of all, of course, supporting VC funds and growth funds. But we also, support partners in the space of intermediated credit. And our reason for doing so is also a little bit driven by the kind of portfolio we run. So funds is like maybe 1/3 of what we do, but the other 2/3 is really debt and equity. And what we are looking for from all these fund investments is actually not just, of course, returns from the funds themselves and impact, but we're also looking for, okay, which are the stories here that we get comfortable with and which we can support with direct debt and direct equity subsequently. And that's really the way we, operate, and therefore very interested in the fund space, but also very interested in direct investing. Yeah.
Interesting. And coming to you, Rolf, I think your perspective, I think you've obviously, whether as CFIM or as an allocator for impact investing, and then I think you've obviously been a long-standing investor from institutions that you represented for investing in India. How do you see allocations to India kind of really change?
Sure. So a lot of it has been said, so I'm not going to try to repeat things. I've been an LP for more than 25 years, and over that period, I've seen a lot of emerging markets come of age. Some have fallen out of favor. In my view, India clearly has earned and is earning its place in terms of allocation from global institutional investors. The market has significantly matured. As Neha and others have said, 15, 20 years ago, India was a great place to invest. You just didn't expect your money back anytime soon. That has obviously changed over the last years. So as responsibility as the head of our funds group, so we manage both the DFI. We are the portfolio manager for CFIM, which is the Swiss Investment Fund for Emerging Markets. That's more than $1 billion. And we also have private mandates. We have a number of fund of funds and separate accounts that we manage on behalf of private money of commercial investors. So as a DFI, India is a must-do for us, right? Like we invest only in emerging markets. So as a DFI, I have to invest in India. There's no way around it. It's 1.5 billion. It's the largest market. Emerging market, sorry. There was a question earlier about the comparison. Where is India different from other markets, maybe Southeast Asia? The answer is scale, right? This is the largest market investable for us DFIs right now. So as a DFI, there's no question that I have to invest in India. As a private investor, I wouldn't have to invest in India. I could do very nicely investing in other markets. As a private investor, I want to invest in India because this is where I see wonderful returns coming out over the next years and the vintages. So as a private investor, I want to be in India because I've seen the evolution of these markets, and I look around, I don't see anything that has the scale of India. Southeast Asia, I think you mentioned it. There's Indonesia, there's Vietnam, there's Philippines, all wonderful markets, but there's a handful of managers across these markets that are investable for a commercial investor like myself. So the place to put money, in my view, really is India. So I try to keep it short.
Okay. And then just to wrap up on this kind of topic, so when I think all of us heard that the Indian market has really deepened, I think what may also be helpful, and maybe Rolf from your perspective to start with, has it really gone beyond? I think it was always that the bigger the funds got, more the allocation came to them, rather than getting new managers or kind of other fund managers getting an allocation. How has that really evolved in India? I know we've seen a significant growth in number of players now, but while allocating capital, is there still more conviction when you're looking at a new manager versus allocating to an existing one? Yeah, maybe okay. Start and anyone else on the panel may want to add.
That. Look, this is a part of the evolution of an industry, right? Many of the managers that are now raising $1 billion or $2 billion, not to go into names, they all started raising $300 or $500 million funds. Those funds get successful. LPs, there's a wonderful book written 20 years ago in the US that's called We LPs, we're our own worst enemies, because what we do, we flock to the large managers, the successful ones that makes them larger, and over time, returns tend to erode. I'm not making any statements about the returns of any of those large managers, but I like to back managers that are young and hungry. Our sweet spot, for my sweet spot, is in the $200 to $500 million range. But of course, as an industry, you need those large managers because they are catalytic for furthering the industry. It is out of large managers, large fund managers that go from 20 to 30 to 50, 100 people that you see spin-offs, and that is something that drives the maturation of an industry. For us as a DFI, we are not here to back the large managers that can raise significant amounts from private investors. Our job is to continue to catalyze the industry by backing newer managers, newer sectors. For example, anything around the climate space is our core interest to us. We know that India is rapidly getting rich, and when people get richer, consumption patterns change, pollution goes up. So this is something that clearly needs to be addressed in India. So our job is to back young and hungry managers. So okay. and not so much the very big managers. Very happy for their success, but they don't need DFIs anymore in that sense.
Okay, good to hear that. So I think, again, just moving on to the next theme, and I think it's really more around LP standards, governance, expectations, ESG. So, I mean, again, from an international LP perspective, or in terms of how has really Indian GPs evolved in terms of meeting the governance standards, ESG compliances? I mean, whether is it really something that you really see them as a check-the-box approach to it to kind of meet some of the standards, or really genuinely there has been an upgrade in terms of how they really look at it as a value creation for the fund? And maybe I think we should start off with the DFI perspective. Maybe Shilpa, if you and Neha can kind of...
Yeah, thanks. But maybe before I jump into that, I can just
address
please. The earlier question, which is that we look for both new as well as we do follow-ons with a lot of partners we trust. And I just want to talk about the difference between the two. So first of all, funds that we've invested in, we actually like to, in a sense, track very closely, not just for the impact that they've delivered, but also in terms of not just the returns, but exit. So I think that becomes like, of course, an important metric. But at the same time, I think newer funds are important to us, especially because we are looking for, partners in newer areas. And therefore, overall, we try to balance both follow-ons as well as newer partners. But coming to, standards, and, for BI being a DFI, responsible investing, especially with the focus on ESG, is really important. And I think the experience has been very good, honestly. I find that partners have collaborated with us very holistically, very deeply in all of these areas. Of course, it's always a journey, and I think one of the things we are trying to do is also move to a more context-specific, fit-for-purpose kind of standards. And of course, one of the things we hear is that different DFIs have different standards. So also working, a little bit across DFIs to see if there are things which we can standardize. But I think, what really I would say I appreciate is that a lot of times these standards have really made good commercial sense also, not just for our GPs, but also for our investees. And I want to share that, I was talking with an investee, a housing finance company, and one of the things he remembered is that, we had asked for all literature to be in local languages. At that time, it was some time back. And he said, because you insisted on that, we did it, but now we realize the commercial sense in it, and we do it anyway. And, that's the stuff which, we really enjoy hearing also.
Yeah, maybe.
Maybe I can add. I think we've had a very similar sort of positive experience. I think when we started about 20 years ago and we tried to introduce a lot of the international standards, whether it is at ESG, for governance, for just basic terms and conditions, there was a lot of resistance. We had to sort of explain the importance, why is it needed, how it sort of helps in the overall sort of functioning and the longevity of the fund, right? When you're institutionalizing a fund, it's very similar to when the GP is investing in a portfolio company and you're trying to institutionalize the company so that it lasts beyond the promoter. I think similarly, we're trying to, our effort was to sort of institutionalize the GP industry where we are saying, hey, it should last beyond the promoter. Not just the one person who sort of started it, but it should be an institution which stays for longer. I think there's a vast difference in the last 20 years, where a lot of people who now come to us are already following a lot of the basics. Right? So we don't even have to talk about, okay, ESG is important. They know that ESG is important, and I think they've seen the sense because they realize that 20 years ago, ESG was seen as one, check the box. Second, okay, it is an additional cost for us to implement it, to validate it, to diligence it, and then to sort of implement it is an additional cost. Today, a lot of times people see that this is a risk mitigation strategy. And therefore, you can avoid a lot of losses that you would have otherwise incurred if you don't have the right ESG practices. There could be a legal sort of suit against you, a case against you if your social standards are not properly followed, your employees are not treated fairly. You could have, if there's an environmental issue, there's an accident because you're not following fire and safety, let's say in a hospital, right? There can be a big sort of reputational issue. I remember GPs come to me and tell me that, listen, thank you for sort of insisting and ensuring that we follow the fire safety in our hospitals, because I was personally on the board of that company. And we've had incidences in India and otherwise where there's been fire in hospitals and lives have gone and it's been really disastrous, right? So even from a liability perspective, it's big. Today, honestly, when a lot of people come to us, they know that this is something that we will ask for and they've already done their homework. We always, of course, fine-tune it, work with them, and that is one of the things that we do when we come into a fund, where we say, okay, how do we sort of help you build those standards, enhance those standards across the fund and the portfolio companies. And I think we see very willing participants and they understand that this is something which is important. And it's not just in India, right? Globally also we've had scandals, corporate governance sort of issues where systems and processes were not strong, where money is siphoned off either at the company level, even at the fund levels, and we've got big sort of frauds which have happened. So people realize that even, and the last point I want to cover here is, let's say, simple things like tech security, cyber security. I mean, just recently we received an email from one of our GPs in India saying, please expect some false sort of notice to come to you. And in the next week, which is last week or the week before, we actually received a distribution notice, which is a false notice. And because we were prepared, we knew about it, and we have our own sort of internal checks and systems. One, the fund manager was able to catch it. And tell us in advance, and then we were able to catch it because of all the basic sort of system and processes that we insist some of these managers put in place.
Thanks. Maybe, I think, do you want to quickly add to something?
I would just add something very quickly. So first of all, I'm almost surprised that the question is like, is ESG real? So the answer is yes. I mean, it's in a market as developed as India, it is absolutely non-negotiable, right? And not only because ESG is risk mitigation, as Neha mentioned, but ESG is also a risk, is a value creation tool, right? I mean, at this point, managers realize that having clean, good companies is easier and better and to sell and achieves a higher price. So ESG should be an absolutely seen corner for every investor and for every GP to put it up on the list, right? The I would say the ESGI is an evolution of the industry, right? The impact, that's a little bit more, we're sort of earlier in that stage. So having an impact thesis, meaning good relationship with your communities, etc., that too adds value. That's a little bit earlier at the stage, but I think ESG really should be absolutely non-negotiable to any investor.
Okay, and maybe any quick from Amit, and I think in terms of diligencing new fund managers, and then how has that process really evolved from your perspective? I think especially for first-time fund managers. Typically, how is there any guidance in terms of, from your perspective, when you are selecting fund managers for allocation? I mean, what kind of could be the few factors that I think the manager should be aware, which may probably not make them pass the first level of diligence, or which may actually make them really get the allocation? Any thoughts on that from your side?
Yeah, I can go. So, I mean, the reality is, you know, high-quality investors don't emerge overnight, right? So, when you have a first-time manager, the reality is they're probably coming from maybe another firm or with some sort of track record of prior investing. So the first level of diligence is to simply look at that and say, okay, well, what is this individual or what has this team done in the past as investors? Because if you can't even point to that, you know, if you're a first-time investor, we're clearly not interested, right? So first-time manager, there has to be a discernible track record of investing capability, right? The second piece is, to be a fund manager really requires two very distinct skill sets, right? You have to be a good investor. That's probably something that individuals come with when they're leaving prior firms or starting their own firms, etc. The second is you have to learn how to become a good fund manager, right? It's all the stuff that goes into running a fund besides the investing. How do you build a team? How do you raise capital? How do you put in place a mid and a back office, compliance, governance, investor reporting, all of that stuff. And the reality is, if you're a first-time manager, you may have been an investor, you've probably been a good investor, but you've never done the rest of the stuff, right? And that is a very critical piece to diligence, to figure out how do they intend to solve those issues, right? So that's one set. I guess the second point I'll make is, how do we think about first-time managers? And I think the reality is, you're taking on certain kinds of risk with a first-time manager that you wouldn't with a more mature GP, right? Investment strategy might be uncertain, pipeline might be uncertain, ability to seal deals might be uncertain. And so what really helps from our perspective is to actually be able to jointly diligence a pipeline of deals, maybe co-invest at first, where you're actually, you know, just kind of checking the tires and saying, okay, does this actually pass muster? So with first-time managers, we definitely have a bias towards saying, okay, is there an actionable pipeline that we can diligence and then come to a determination, okay, these are deals, you know, the fund manager is still unproven, but the deals look like they could be, you know, good. So that's our approach.
Okay, no, that's helpful. I think just moving on to the last theme, and I think that's really more about risks of investing in India, and how do you really price some of this risk in when you are really looking at allocating capital to Indian GPs. Maybe I think, Rohit, we can start with you in terms of how do you really see the risk, evolution of risk assessment as far as India is concerned? Currency, political, regulatory, all of that, and how do you think that has really changed over a period of time in terms of the...
Sure. Sure, I can go there. I think when I spoke about India and the opportunity set there improving, right, I think that's fairly clear and obvious. Now when you think about, okay, why is capital coming here, or why isn't as much capital coming here, then you need to basically put the whole risk return concept or construct of India and compare it to some of the other markets. And we've been talking about that a little bit, right? If you think about India and, you know, call it any deal, there are 2-3 major risks that happen there, right? So one is regulatory and geopolitical, right? I think that is something that has been elevated over more recently, and that has been elevated across markets. And India is, call it, no different there. I think we enjoyed a very favorable geopolitical situation, position till about a year and a half back. I think now it's become a little bit more shaky, so people are looking at it a lot more closely. However, the good thing about private equity and private markets is that you're really investing for the long term. So you need to put these risk the risk in context of the duration of the investment that you're looking at, right? Now, if you think of it from a 10-year perspective, I think from there, is India going to be in a more favorable geopolitical position compared to some of the other markets that we see? I think so. And a lot of that really depends on just how the geopolitical pieces are being played out and the favorable position that we have in the market there. We do have a key person risk in the current, call it, political leadership of the country domestically, where we don't know what happens in case you know, sort of there is a key man event that happens there, and, you know, sort of what would be the natural course of progression from there. So there is a bit of a geopolitical risk that comes in from there, but it is, in my opinion, a lot more manageable. The other place where India again fits favorably compared to the world is the financial risk. If you think about some of the other markets that, you know, sort of people have invested in, call it the US, Japan, etc., a lot of the deals there have pretty high amount of leverage that sits within the cap tables, and a lot of the returns are driven by financial leverage. When you look at investing in India, on the other hand, you know, sort of the deals don't have as much financial leverage, and that really positions our businesses to be a lot more resilient. Now, leverage obviously has worked well over the last decade or so, given the low interest rates and the declining interest rates that we saw globally. But going forward, that's a place where India can, call it, outshine the others and probably benefit from what it has always been doing, which is, in, call it, managers who have been focused on finding growth companies, helping the businesses grow, and not really relying a lot more on financial risk and leverage. Where I think India is, where the risk in India gets a little bit elevated, is largely around competition and valuation. And this is nothing new. You know, we've been talking about the deepening of the GP ecosystem in India and how we now have GPs across the different check sizes, different deal types, etc. But what has also happened over this period is that we've had a lot more investors come into the market. I was listening to a podcast earlier which talked about, how more and more Indian family offices, call it the people who are inheriting the family offices, they are looking to come into investing and making their day job investing as opposed to running the family businesses. And that makes a lot of sense if you think about, if you have an X portion of capital and if you can invest well on it, the amount of returns that you can get from there are probably higher than the value add that you can do in the individual business itself, which is leading to a lot of succession deals for private equity. But what that's also doing is bringing in a lot more investors into the Indian ecosystem. And what that does is that more and more deals get priced to perfection. More and more deals get priced to a point where GPs need to really add value to deliver the returns and still meet the return hurdles that they are seeing from their global peers elsewhere. So to me, that is called one of the biggest risks that I see in the Indian market. And the winners there would be GPs who are then really able to build those bilateral deals. And when I say bilateral deals, it's not because they're cheating the entrepreneur and giving them a lower price, but they're really getting into the right partnership with the right entrepreneur, having the right vision, such that they can drive the disproportionate growth, really, sort of leverage the growth of the economy, leverage the shift of going from unorganized to organized, and really deliver value from there. And those were the ones who really stand out.
Yeah, maybe Amit, you want to add?
Yeah, I have a couple of points I'd like to add. So one is, when we think about underwriting investments in India, there's a couple of risks that I guess GPs can't really do anything about because they're more systemic, but they're basically currency and taxes, right? I mean, the reality is that the rupee, so as a dollar investor, because our capital is in dollars, the rupee is depreciating, call it 3 to 4% a year over, on average each year. And then at the end, when you exit the deal, you have capital gains taxes of 13 to 15% and, can vary obviously. But those are two big drags on returns that competing markets don't necessarily have, right? So as I think about our investors, when they have a choice of markets to invest in, the fact that you're losing returns to currency and taxes is a negative on India relative to other markets. So I think that is something as an industry, as we think about what it is we want to submit to the government in terms of how PE as an ecosystem, as an industry can evolve. Currency obviously is hard to do much about, but taxes, the taxation regime, having true pass-through entities, et cetera, that becomes very important. So that's one aspect. The other is, it's true what Rohit described, right? The idea that because there's no leverage in India, you're getting unlevered returns. The challenge is if you have to invest solely through equity, equity will price in premium growth, right? So yes, it's true, India's growing faster than most every other major market, but you're paying for that growth, right? Largely, on average. So we like to tell our investors that yes, the bulk of your PE exposure is in the US, it's all levered, there's financial engineering risk. The reality is when you have a deep enough capital market, you can be pretty ingenious in terms of financially engineering liquidity to your LPs. And I think India is really at an early stage of that evolution. I think, ideas like, for example, permitting banks to provide acquisition leverage, I think that's a great move in the long term because that again creates another lever that GPs might be able to use. But I think financial leverage, financial engineering, to the extent that that can be brought into PE in India is going to be important for the long run.
And I think there's obviously been a pretty significant change on that count with RBI allowing acquisition financing and then also relaxing ECB norms for its end use and a lot of those. So I think very clearly that will obviously help to a certain extent mitigate. But I mean, again, I know we are run out of time already, but I think maybe from my own perspective on risks, currency risk, valuation risk, I think as pointed out, I feel at times the political risk or a regulatory risk, I think there's a need to really re-rate India because I think we still continue to carry at times the same emerging market mindset. I think today probably the political stability that India demonstrates in the regulatory framework that it has evolved, I think it's probably not, if not any better than other market, definitely I think compared to at least many of the emerging or even developed markets, I think India can probably stand in line. So I think that may be one re-rating that I think the global LPs and allocators really need to do. So I think with that, I think we've obviously taken up our allocated time, but if it's okay, we can take one or two questions from the audience, maybe one question. Okay, I think we have one.
Am I audible? Yeah. To the distinguished panelist, my one and single question is...
Can you be a little louder, and maybe if you can introduce yourself as well?
Yeah, I'm Shubhadeep Das. I'm an executive director with Great Value Capital. We have a special situation fund of our own. The question that I would like to ask the panel is that regarding data and information risk, or asymmetry as we call it, how do you think the country in the PE space has evolved vis-a-vis, 2016 versus 2026? I mean, the last 10 years, has the country done well in terms of data and information sharing and asymmetry, be it on a research, be it on the market, be it on the project or the company that we have invested in? And I would like to take your view on that.
Yeah, I don't know, Rohit or...
Maybe I can take a shot. Just to clarify, is your question on whether data and information from GPs to LPs, is that the question? Or is it data and information?
It's the data from the underlying asset or underlying investment to the LPs and then flowing to the GPs. Because when LPs get the correct data and correct information about the project they have invested in, the market, the overall industry, then only they can pass it to the GPs.
Correct.
So from place where the money has gone, the information and the data that comes in, is India doing better vis-a-vis, 2016?
So is it really, to simplify, portfolio level information really
Asset
getting
level and
translated?
portfolio level.
Okay.
So I think if I look at it 10 years ago versus today, I don't think it was a case of the underlying portfolio companies not sharing information or not able to share information. It was a question of two things. One was the quality of information that they gather and therefore are able to share with their investors, which is the GP in this case, or the private equity funds. And then the ability of the private equity funds to collate all that information in a digestible format and then share with their LPs on a regular basis. I think on both counts, I think as an industry, we are doing much better. When I say we, I'm talking about the private equity and VC industry as GPs. I think we're doing much better because one, we are able to implement a lot of these MISs, the information systems, which is now, I think, a standard 90-day, first 90-day value add plan. Right? When I talk to any private equity firm or VC firm, the first thing we talk about is, okay, so what do you do with your company? And they say the first thing we do is put in place the right systems and processes so that we can get the right data, we can measure the right data, track the right data, and therefore then implement changes if we need to, course correct if we need to. And I think at the GP's level as well, we have seen that improve significantly where also it's a question of at what stage is the manager. And therefore, whether they have the bandwidth to actually collate all of that, how large is their portfolio, how easy is it for them to collate and then share with the LPs. But I think as an LP in about 50 odd funds now, I see that it is definitely much better. Today, if I ask for information at the underlying company level, it comes much faster in a much better sort of quality format versus maybe 10 years ago. So I think we're definitely doing much better as an industry at both levels, the underlying company level and then at the private equity firm level, 100%.
Okay, I think I know we'll try and contribute to some savings on time. There are some questions here, but I think we'll probably close the panel. I think maybe all of us will be around for some time, so I think definitely you can pick it up. But thank you so much to each of the panelists. I'm sure I truly enjoyed the interaction, and I'm sure there's some takeaway for the audience here, so thank you so much. And thanks to IVCA for putting this fantastic panel together for us. Thank you.